Sorry.
Are loudspeakers on?
I will speak up.
All right.
I will speak up, closest to the microphone.
I'll move forward.
We don't have microphones. They are for the live stream.
Right. So I will speak up. So this government was elected on a very firm promise to level up growth across the country, and the new Prime Minister, the new administration has made it a clear priority to support people with the cost of living, but also to unleash growth and opportunity and to give people more of a stake in society. We obviously have at the moment a challenging economic backdrop with rising inflation, rising interest rates, and some of the challenges that are associated with that. And so there is a real need, I think, to exploit the fantastic innovation and capital that exists within our financial services industry, within the banking industry, in order to support people with those challenges and to help people get on and get up. The focus, when we think about banks, is often around the role of banks in supporting businesses, to support investment, to support growth as lending institutions. But actually, I think there's a really interesting role about the role of banks as consumer-focused organisations, as organisations that provide innovative products and services to families, to help people save, to help people manage their bills, to support people into ownership, to let people take greater control over their own lives and to kind of take advantage of the opportunities before them. And we know that the financial services sector, the retail banking sector in the UK, is a hugely innovative market and one of the great commercial strengths of this country. So I'm thrilled to be able to host this event at a challenging time, but with huge latent strengths within industry. And we're keen to get into different questions. So questions like, what more can banks and financial services, retail banks do to support consumers and families at this particular time? How can different business models, so we've obviously got a building society on the panel, but how can different business models like mutuals and building societies contribute to that? Is there a role for different types of retail bank within this conversation? And what should the government do to support that? What is the role of the state, the Treasury, Andrew's role in supporting some of that innovation? I'm delighted to be joined by an all-star panel here today. Andrew Griffith, recently appointed Financial Secretary to the Treasury, formerly the head of the Prime Minister's Policy Unit, someone who's thought about these issues in a number of different roles, and a deep policy thinker in many respects. Andrew's relatively recently in post, but I know has thought considerably about lots of the issues before us, so delighted you're able to join us. Thank you for giving up your time, Andrew. I will then come to Tom Reilly, who's Director of Banking and Savings at Nationwide, someone who leads Nationwide's banking and savings products, and he was previously responsible for mortgage product development, pricing across prime and specialist markets, and a whole range of other activities at Nationwide. And then I will come to Jane Tully, who is Director of External Affairs at the Money Advice Trust, an organisation which is doing a huge amount to support people with the cost of living at the moment, and over the last 30 years has supported people with financial difficulties to support them into financial security. So a fantastic panel. We've got just under an hour, so I'm going to close my opening remarks there and hand over to Andrew for some opening thoughts. Andrew.
Fantastic. Thank you. That's for the audio, right? Look, thank you very much, Will and Onward, for having us, for bringing this really important topic to discussion. It'd be interesting to hear what both Tom and Joanna has said. We've got some good diversity here. So, look, there's two big lenses that I think we should look at this through. The first is, and probably the more traditional one, is to look at our successful retail banks and the financial services sector as a big powerhouse of the economy. We're not going to grow unless we can grow our financial services sector. It's about 11% of all GDP. So if we don't manage to grow that and maintain its competitiveness, then that would be a drag rather than an accelerant. And so that's a big part of it. And within that, we should celebrate the rich diversity we've got. We've got fantastic brands, we've got different business models. I absolutely would like to see a proliferation of more business models, credit unions, mutuals, building societies, as well as the commercial sector, because I think that diversity offers a range of choices for consumers. And we want an innovative, vibrant industry. And so having a variety of different providers, making sure we create not just level playing fields, but we try and seek to lift them all up. The second point, which I think we'll talk a bit more about today, we don't talk as much about, is the importance of consumers, households, being able to access a diverse range of products, that they stay dynamic and relevant. We've always got to look at the challenges of the sector in terms of the availability of credit in general. That is a magical product, the ability to provide people with credit, to build capital, to accumulate assets over their life. That's properly doing a really, really important job in society, and we should celebrate the core purpose of that. But we also need that to move with technology. So when we come to things like mortgages, one of the big things that I've spent a lot of time thinking about is how we help generation rent, which is a proxy for one of the big challenges of our time, which is intergenerational fairness. And it's often not the affordability, it's often the access to a deposit or the access to a regulated product in the first place. So I have just an incredibly difficult job, which is informed by the sector. There's a trend to lift consumer protection and to have a lot of a rules-based approach. What that often does is lift people out of the ability to get credit entirely, and then they have to fall back on the informal, unregulated sector, which has difficult consequences. But obviously we can see the balance between also making sure that products that are brought forward from brand names from the regulated business are fit for purpose and offer a fair deal for customers. I suspect that's something that everybody on this panel recognises. To a degree, technology can be our friend. So initiatives such as being able to enhance your credit score by taking into account your track record of rental payments, it's just a simple deployment of technology. It means that you'll bring in a broader range of risk factors than traditionally just metric-based mortgages. That's just one example, but I'm really keen that we have innovative products, a diverse range of providers, and that we leave as many people in the country as possible able to access the regulated credit sector. I'll stop there, Will. Thank you.
Andrew, thank you so much. That was a fantastic introduction. We covered actually quite a lot of ground in quite a short space of time, but kind of a very clear statement of intent from you as the Minister that you want to see this market become more diverse and embrace innovative products that really do target consumers' needs. Tom, that's a great jumping off point for you to put some points.
Yeah, of course, thank you. So, as it's been alluded to, Nationwide as a building society, we are quite different from the banks. We serve a lot of the same customers, or as we would call them, members, but as members, they own the society, so we don't have any external shareholders. So while we're subject to a lot of the same external pressures, actually it does enable us to take a different approach. And I do think, as we were discussing briefly before, it's a really important part of the overall diverse financial services industry. I think a good example of that is what we're doing at the moment in terms of our cost of living helpline. So we've actually put in place a specific helpline and trained all of our frontline staff to be able to support our members with cost of living challenges. We've seen a really good response to that service from our members, and quite a diverse range of needs actually, right from kind of just I think a sense of worry and seeking some reassurance at the present time, right through to those members who actually are in a more challenging financial situation in terms of actually encountering financial difficulties, where we'll do an internal referral to our specialist team who's able to support them, but also we do work closely with organisations such as James in terms of access to broader debt advice. So that's been a really important thing that we've done. I think it's just a good example of what we can do in the mutual sector, just to approach a broad problem, but just in a slightly different way.
Fantastic. Thank you very much, Tom, and really useful to have practical examples from the sector and specific things that you are doing to support people at this challenging time. Jane.
Great, it's a pleasure to be here today. I work for Money Advice Trust, which is the charity behind National Debtline and Business Debtline. Our advisors are based 5 minutes up the road, so I was there this morning, and they helped over 170,000 people by phone and web chat last year. The last few years have been really difficult for many people, particularly small business owners that we help with our business deadline service, but also many households who are still reeling from the effects of COVID on their finances. And the cost of living crisis we're seeing is just bringing new financial pressures to these households. What we're seeing on the front line and what our advisors are hearing tells us this story firsthand. So from National Debtline callers, the average personal expenditure has risen by 7% in the past year, but their average incomes have increased by 1%. Bearing in mind these are people who are already on very low incomes. We are seeing more people with deficit budgets. That means their income simply isn't able to cover their essential costs like rent, council tax and energy bills. So 45% of the callers to our National Debtline service are in that position now, which is up from 37% years ago. This isn't just impacting on people's finances, but it affects their health and well-being too, particularly the people who call our services who are quite stressed about debt. Our recent research found that about 1 in 9 people had gone without food in the past 3 months because of rising living costs, and over 8 million people were saying that they were losing sleep regularly because they're worrying about money. So that's the story from kind of a wider sample of people we've pooled rather than just our services, who are people who feel it most extremely. So the challenge we face is now significant, and people are fearful about their finances. We know that retail banks can't solve this problem alone, but they can play a key role in supporting people through difficult times. People's budgets are going to be stretched even more over the winter, and it will make it harder for them to make their debt repayments. Tailored additional forbearance, like that what we saw during COVID, which the banks very much led the way on, is something that we will need to see again across all sectors, particularly in energy, and we've been calling on Ofgem and other suppliers to deliver. I have to say, and I think a lot of the debt advice services would agree, that it was a credit to the financial services sector throughout COVID that so many people were kept out of debt, and the forbearance that was able to be applied at that stage. We recognise that can't continue at those levels, but it's great to see that many of the practices that were introduced in that period are now mainstreamed into banking practices. The action government has taken has also been welcome, not least the energy price guarantee, which provides much needed relief. However, there is more that's needed for people on the lowest incomes, in particular looking at significantly operating benefits, which we've been talking quite a lot about today. And as much as that, we also need safe routes out of debt for people who do fall behind, and that's why we're supporting plans like the new statutory debt repayment plan, which will give legal protection to people from creditor action who are looking to repay their debts. We're also feeding into the Insolvency Services review, the current Insolvency Service framework. Before I finish, I just want to highlight something really important here today, and that's with many financial crises, the impact is just not felt equally by people. Our recent research found that people on lower incomes, people living with long-term health conditions, a disability, or people from ethnic minority backgrounds are all more likely to have felt the financial impact of rising costs. So while 1 in 5 adults was telling us they were behind on bills, that is 45% of people on means-tested benefits, and 39% of people from an ethnic minority background were saying behind on one or more household bill, compared to 18% of people from a white background. We think that retail banks need to be very much alive to these inequalities and make them a focal point of their customer engagement and support strategies. So while our immediate focus is on supporting people through this cost of living crisis, particularly those in or at risk of problem debt, we need to look ahead as well. How can we support people recover financially to build their future resilience and achieve their ambitions? There's a clear role here for for the retail banking sector, and we look forward to discussing more about that today.
Jane, thank you so much, and thank you to all of our panellists for those opening remarks. I'm going to abuse the position of the chair for one moment to ask some questions to our panellists before I hand over to all of you. So if you have questions in a moment, please do put up your hand. But I've got a question for each of you, if that's all right. So my question for Andrew is actually just building on what Jane just said there about tailored forbearance and some of the extraordinary interventions that we did during the COVID pandemic. Just wondered, we are going into a period where people's energy bills have doubled, even with the government's help over the last year, where interest rates are rising. There are people who are feeling the pinch quite considerably, and that's only likely to increase over the next 6 months or so. Is there a case for government working with the financial services sector, the retail banking sector, to develop targeted measures to prevent people from falling into debt? And if so, are there things that you would particularly point to that you would be looking to explore?
Look, I'm open to, first of all, I'm open to ideas. I mean, it's pretty new in the role. I'm unencumbered, so let's look at that. The big decisions the government has made is to do two things. One is have the biggest intervention of financial support for households and businesses of any major economy. I mean, it's really much, you know, it's hard to understand the scale of it. It's much larger than the furlough. The furlough was relatively targeted. It covered a subset of different businesses, and it was a percentage of those in work. This covers every household, every business. In the case of households, it runs for 24 whole months, and it absolutely takes off the table the increase in energy costs beyond the level that we've currently seen. So, it doesn't mean obviously there aren't some headwinds for some people. The second thing is obviously the package for the most vulnerable, with that up to £1,200, which models suggest for many people in that group removes the entirety of the energy cost uplift. Now there will be some within that are living in particular household combinations for whom that isn't the case, so I don't want to overstate that. But there's two very big, very macro, simple by design and fast by design influences. And of course the purpose of that is to work upstream. So you know, I think the sector we've got is very responsible, and so I'm interested to hear where there are gaps. I accept there'll be some challenge on that, and I'm keen to hear that, as I know Tom will be. But in general, we have a very strong system of prosumer regulation. You know, the regulatory environment is strong in this market, and where there are issues, I think we should be quite data-led. There's a lot of anecdotes, and I understand that. But the more that we can actually, if we want regulatory intervention, we'll do that where it's appropriate. But we should be quite led by the data around this area. None of which removes the fact that I understand even before coming into energy, there's a lot of people in this country who are just generally in a situation of financial stress. And some of that is about early education, about financial instruments. It's about access to inability to access highly regulated credit solutions, and therefore reliance on less well-regulated or unregulated financial solutions, and that's obviously a concern.
Thank you, Andrew. Tom, could I ask you specifically, this is again building on something James said, but about actually, we talked a bit about the role of technology in supporting people through the cost of living, but is there a role for physical engagement with consumers? Because we know, just from a levelling up perspective, we know that there is a distributional challenge in terms of access to financial services in many parts of the country. Is there a role for physical branches, access to kind of bank counter services, etc., in this crisis?
Yeah, absolutely there is. And there's probably 2 points I'd make on this, one kind of nationwide specific, one broader. So Nationwide has what we call our branch promise, runs until 2024. and states that we will not leave any town or city where we currently have a branch without a nationwide branch over that period. We've kept our branch numbers very stable over recent years. It means that we now have actually one of the largest branch networks, and we found that to be really useful in talking to local people in their environment, you know, with our staff members who of course are also local people and understand the nature of the situation within that area, and then have access to the kind of cost of living tools and support that I mentioned at the start. The other kind of sector, though, I think, you know, it's a good opportunity for me to mention as well, is the credit unions. Credit unions work on a very localised basis and are able to support people in local areas with both building a savings habit and also with responsible borrowing at reasonable rates, and they're able to do so because they have such good knowledge of that local area, and they build really strong responsible lending relationships with their members. So I think it's just a couple of examples of where that regional focus and that physical presence is really important.
Yeah, fantastic, thank you. And Jane, I was going to ask you to just say a little bit more about where those spending pressures are coming from at the moment. Like when we talked about it a little bit before, but what is driving some of the demand to your call centres, to some of the engagement with your colleagues? Is it energy? Is it interest rates? Is it other things? Just to tell us a little bit more about where some of the pressures are coming from.
Sure. So with debt advice services, if you went back to the time of the financial crash, about 2010, and if you looked at the profile of the clients who called us, it was by and large people with loans and credit debts, and they were the significant debts that advice services were helping with. And I have to say, it is due to the introduction of much more robust financial services regulation over the last 10 years that the proportion of people contacting us with those types of debts, where potentially there had been risky lending in the past, you know, has really come down quite significantly. But what we've seen replace that is the proportion of people contacting us with what we call cost of living debts, or debts on household bills. And this has been growing year on year. So, you know, while we're seeing a kind of a real crisis sort of in this at the moment, there's definitely been an affordability issue for many households for some time. So the proportion of people contacting us, for example, with energy debts, that was about 23% of people calling us last year. It's about 32% this year, which is quite significant. Council tax debts, about 1 in 3 of our callers have those. Water, you know, it's really the kind of the day-to-day living costs. And the reason why that's so concerning is because these aren't, first of all, they're what we call priority debts, most of those. They have legal consequences if someone's in a position where they're unable to pay them. And secondly, this is about day-to-day living costs. This is about people getting by week to week, whereas financial services related debt, often you can negotiate a kind of a repayment package with your creditor, and you can find a way of gradually making those payments back. But when it's energy, and you still have to pay your energy bill next month, where do you go with that? So that's the big concern, I think, for us at the moment, and we don't see that trend of kind of a shift to cost of living debts abating anytime soon. And the concern, as I said then, is many of those are priority debts, and the creditors are able to take legal action, which sometimes, you know, will accept is needed and is necessary. But that legal action itself is incredibly stressful for people, and it's the scale that we may see of that over the next while that's particularly concerning.
Thank you very much, Jane. So, can I ask if anyone in our audience has questions? The gentleman at the front, and there's a gentleman at the back as well. I'll come to you in a moment.
So me,
Yes, please.
yes, if I can speak on behalf of the elderly handicapped, which I think I just about qualify for, but interesting, something Jane referred to, I work with ethnic minorities as well, they also come into it. I'm afraid this isn't quite what I thought this was going to be about, but it's still relevant here. It's actually the ability to communicate with financial sector, and HMRC are really awful, I'm afraid, Mr. Griffin. And I'm glad to hear Tom saying that they're keeping their branches open, because more and more people, and local authorities are as bad as anyone else, ex-councillor, are trying to force people to do everything online. There are many of us and I don't suffer badly, but many of my colleagues do, who are elderly, who are disabled, or indeed ethnic minorities who find difficulty using it, who cannot use the internet, or if they can, they can't use it adequately. And yet, more and more branches aren't there. More and more, if you try and phone people, they either don't answer it, or it'll take you half an hour to get through. So my plea is, insofar as any of you can do anything about it, can we try and ensure that provision is made for the people who can't use the internet to go? In this sense, I just heard a case yesterday of a bank who have been sued for not offering their best rates to people who are not on the internet, and they've been found guilty of discriminating against that person who can't use the internet. So keep my fingers crossed that might go somewhere.
Okay, thank you very much. There was a gentleman at the back. I'm going to take a couple of questions at the same time, and then I'll come back to them.
Hi there, Ed Burkitt from Onward. I run our energy programme. So just a question actually on retail banks and whether they can be used to help the government target people who really need support. So we're talking about how large the energy package has been universal. Ideally, it would have been more targeted so that richer people in particular were encouraged to cut back, and also as a sign of fiscal discipline. Is there something that retail banks can do to actually help the government access data on who is actually struggling and who isn't, and therefore could allow in future, potentially next winter, for any support package to be more targeted?
Okay, fantastic. Thank you very much. Andrew, would you like to comment?
Yeah. Absolutely. I mean, we're an ageing society. The wonders of capitalism and private, enterprise and innovation means that in general, certainly over recent decades and hopefully going forward, we're all living longer. But not all of that life is at the same quality. And any transition, because we know that digital opens up, wonderful opportunities, and in many cases it's very pro-inclusion. It reaches out to parts of the community that wouldn't necessarily be able to access the branch. They're working night shifts or they've got caring responsibilities. So internet, 24-hour telephone services can be very good for inclusion, but it's absolutely vital that particularly the industries themselves come forward, because that will be more dynamic than statutory regulation, but also that there is a safety net, statutory safety net if necessary, and the Financial Services and Markets Bill does have that in terms of access to cash. Things like the branch bank hubs, I think are a really good sort of way of providing people with that continued access to face-to-face. And you make a good point that my domain is the financial services regulatory structure. It's not even HMRC, that's colleagues. But we really do need to see that across local government as well, because you can't pay your council tax. Sometimes you can't get a parking permit. So I can be quite messianic about the opportunities of digital government and e-connectivity, but we're only going to unlock that opportunity if we have particular solutions, access solutions, for those that will remain, possibly even grow, quite a sizable proportion of the population. So absolutely get that, and it should be beyond the wit of man to be able to do both of those things in the 21st century. There'll always be a face-to-face provision for debt advice. That's something when the government puts a lot of money into it, as does the sector. There are face-to-face things like citizens' advice bureaus, but there's a lot of third sector support as well. And then very just briefly, Tom will talk about much more in terms of what the retail banking sector can do. I think there's two really big contributions that it makes. The first is its general brand power. Something like Nationwide, but any of the big retail banks, they spend a vast amount on building brands. Those brands speak to trust, and in the right regulated way, they're a fantastic way of educating consumers, both about money in general, but also about products. If you don't know about a product, it can't help you, and a lot of the products they bring forward do help people. But secondly, there might be something, it's early days for me in this role, but there might be something in open banking. The UK has been pretty progressive in the open banking standard. That means all sorts of clever apps can help you manage your money, because you can sign up and they see where your outgoings are going. They can often help you switch or find better deals. And again, that's quite a market solution. It's something that the industry have done a lot of work on. UK Finance have brought the participants together, and the government, of course, has supported that with a mandate. So there might be something in that. Not fully up to speed with that particular element. Perhaps Tom or Julie knows a bit more.
Tom, do you want to comment? I mean, particularly on this question about what more retail banking can do, perhaps.
Yeah, so I mean, it's a very interesting question, and I was just reflecting on it a little bit further then, which is, I think we need to be careful how we feel about banks and building societies providing what would be personal information or indicators on your sort of solvency or broader financial status for the purposes of receiving support, as opposed to the information that's already available through HMRC and through benefits, etc. That's a very interesting, both philosophical and GDPR type debate. So I'm kind of instinctively a little bit cautious about that as an idea. I agree, Andrew, with a lot of what you said there about the importance of face-to-face alongside digital. Just to go back to that question as well, the Access to Cash group is doing really good work to protect access to cash in communities. So and I think it's also really important, both in terms of in communities you talked about ethnic minorities, perhaps where English isn't the first language. A local branch presence can be very helpful with that, and certainly, I can't speak on behalf of competitors, but certainly at Nationwide, if a member is unable to access the internet due to their personal situational characteristics, that's something that we would then help them to make sure they can still get the same deal as if they were somebody who was regularly on the internet. So yeah, very conscious of all of those factors that you described.
Thank you very much. Jen, you want to comment specifically on this?
On the face-to-face issue, I mean, it's an interesting one because we work with people who are in vulnerable circumstances all the time, and National Deadline provide its telephone and digital advice, so we don't do the face-to-face bit. But the ethos of our organisation is that we're a self-help debt advice agency, so it's about helping people to help themselves. We don't take people's debt problems off them and then fix it. We equip them with the knowledge about their rights and their responsibilities, and we enable them to then go back and negotiate with the creditors themselves. And what's interesting with that is it's right for lots of people, but it's not right for everyone. And sometimes people do need a more tailored casework, face-to-face service, in which case we'll pass that person through to citizen advice, a different type of help. But what surprises us all the time is people who perhaps might have been, we might have made an assumption that they couldn't do assisted self-help, or we might have made an assumption that digital or phone advice wouldn't work, but actually it equips them and it empowers them perhaps in a way that someone taking their debt problem off them and dealing with it in a different way doesn't do. So, for us the challenge is always identifying those people at the right point and at the right time and making sure people get to the right place, and there's no exact science behind it, but having that plurality of provision, I think, both in retail banking where you've got different options, but also in services like advice are really, really important.
Sorry, two people referred to citizens advice bureaus. Certainly in West London, I think they've all closed down. Now, it's not the universal panacea that people frequently refer to.
Understood. There are a few other questions which I'm keen to get to. So, gentleman in the third row back, and I'll come to the gentleman in front, and then I'll come to you after that. Peter.
Hi, yes, good morning. So my name is Peter Udale. I'm a director of Responsible Finance, which not everybody might be familiar with here, but our organisations are community development finance institutions. And part of a number of them, I think there's about 12, are actually participating in personal lending. And their role, they're social enterprises, and their sole purpose is to help people get out of debt. I think just speaking to that point there. So we try and pick out people that we can help. So it's a subcategory. We advise them perhaps on benefits they might not be claiming, all of those things which can help them rehabilitate themselves and help them become customers of banks again, good customers of the banks, and that's entirely our goal. I noticed when Andrew was talking about business models, he didn't talk about this sector, and in fact, it's been a sector supported by dormant assets, and we hope that in the dormant assets consultation, it will be helped again. But the value I think created by that by those group of people doing I think really professional work in helping people get back on the good credit ladder is probably under-recognised by Treasury, it has been in the past. I think there are things that the government could do if it chose to. I think encouraging banks to work more cooperatively with CDFIs would be really good. We just want to help create good customers of the future. And in order to do that, we need to keep interest rates as low as possible. But we still have to get finance from somewhere. And so, our rates, the lower we can get them, the better that, the more relationship, budgeting, support that we can provide. But I think if the minister were to shout it from the rooftops and say, these are really good, and we hope that the financial sector would come together and help support these sort of organisations. I think there's a role for credit unions, they do a brilliant job as well, they help people, but you also need people coming at the bottom who are real professionals. And so I would implore the minister to think about that and to see whether there's more he could do.
Thank you very much. Gentleman secretary.
Hello, yes, Shane Morgan. So I'm actually working in the legal profession, specialising in corporate financial risk and for lots of the big banks and our clients. One question from the gentleman's previous question. What does the panel think of the likes of Goldman setting up Marcus and JP Morgan setting up these very large digital banks which are very sweeping the market? I mean, there are a lot of the big corporate there, HSBC, NatWest, Barclays, they're trying to sort of play catch up. And we've got these two big platforms there. JP Morgan's very big in America with the Chase brand. We've seen on the news at the moment, it's really heavy pushing the campaign. What does the panel think of, although we want to keep the branches open, how do the retail banks compete with this massive American drive for digital banking?
Thank you very much. And I'm going to take a third question just to make sure that we have time to get in. So, women just
Hi, Jen Evans from Luther Pendragon. One of the things that you mentioned was open banking and kind of the benefits that it can bring. Recent pieces of research that we've done into open banking have shown that there's quite a low level of take-up and a low level of understanding of some of the benefits that it can bring. So my question to the panel is there more needed from government to kind of support the rollout of open banking? And also, does there need to be more from the retail banking side as well to encourage that take-up?
Thank you very much. So CDFIs, changes in the retail banking market, new, especially American services coming on, and open banking, what more we can do to support that. Why don't I go reverse order this time? Partly to give Andrew a bit more time to think, but also just to shout out. So Jane, could you, on any of those?
I was just going to take the open banking one in particular. So within debt advice, open banking was seen for a long time in the early days as being panacea to helping people with their financial problems, because you strip the details from all the different bank accounts and it automatically populates their income and expenditure statement, and then you can give your debt advice off that. It just doesn't work like that in practice. People's bank accounts are so complicated, and the investment, the time that I've seen, the airtime that I've seen given to open banking for being the panacea and the solution, and the number of kind of meetings that I've sat in where it's just held up as being, the kind of the future of where debt advice goes and making the debt advice journey more efficient, etc. It doesn't deliver that because of the complexities around it. And I'm not suggesting that we shouldn't continue to invest in it, but I do think we need to be careful to be very realistic about what is achievable with it. Consumers are understandably and naturally a bit cautious around wanting to kind of share their data in that way, and I just think it's a development that will lead to something else in time, but I'm not sure it's the answer in itself.
Thank you very much, Jane. Tom.
Yes, I mean, a build on Jane's point. I think open banking is a really important enabler. Actually, does enable a great deal of new connectivity and functionality that simply didn't exist. A lot of, there is a reality though that of course implementing all of the open banking changes has been very complex and expensive for the banking industry, and so I guess my plea would be to make sure that future developments are focused on places where there is a real genuine consumer benefit that's demonstrable, and also where there's a commercial use case so that it can kind of become self-supporting. I think to touch while we're talking about digital products quickly on the point around the American banks, and clearly it creates a challenge certainly for the likes of Nationwide. So Nationwide as a building society is regulated differently from the banks. We have to bring in our funding, or at least 50% of our funding from retail members, and therefore directly the target market of the likes of Chase and Marcus, and we can't just flip the mix to drive in more on a wholesale basis. But I'm not going to be too critical, because the reality is that competition is good for savers. They've offered very good rates. They've driven up the rates that are available to savers. So I kind of just see it as that's something that's part of competition. That's kind of part of life. And then just finally, quickly on your point around your sector as well, and apologies for mentioning credit unions and then not mentioning the work of organisations such as yours, which I think are really important. And I'm actually the industry champion for the Banks and Building Society sector on the dormant asset expansion scheme, so it's a cause close to my heart. I think better collaboration is really, really important. I'd be really happy to connect with you offline on that.
Fantastic, thank you. Andrew?
Yeah, I mean, a lot of consensus, I think, on that. My apologies, it was you I had in mind. We met yesterday for the first time. and when I was talking about a diverse range of providers, but CDFIs didn't trip off the tongue. So my apologies,
it's not
Peter.
very snappy name,
But we'll meet in the coming weeks, and the point that I think runs across all of these is a continued desire for diversity and innovation, and for the sector to keep moving. So there'll be new entrants, but as I was saying to Tom, we've got in a way some of the challengers, some of the diverse providers already in the market, and so we shouldn't go hell for leather just to do that. And I'm sure something that everybody sort of says in their own version is having a level playing field. So when we do apply, there's quite a lot of regulatory costs. As I say, I have to manage the fact that the more regulatory costs we apply on the sector, the more you do push people out of the sector into the unregulated piece, which is, it's never represented in this room or on this panel, but for many people, borrowing from a family member, or from getting informal credit from the corner shop, or even someone who's more predatory, is the flip side of that regulation. So we will keep a very close eye on what people would regard as a level playing field, and if new entrants want to come in, are they subject to some of the same standards, some of the same rules? Are they picking up their fair share of things like the financial services compensation scheme? There's a lot of costs that Tom would be able to reel off better than me that we impose on some of our biggest existing banks. We're just going to be careful that we don't so bear down there that it makes life for new entrants too easy, and we lose some of the good things about the system we've got today.
And can I just press you particularly on the second question about the kind of role of new American style kind of banks? That's just good diversity from your point of view, or does it pose challenges for the UK sector?
No, that was sort of my point.
Yeah.
As long as it's sort of a level playing field. I mean, it's there's a lot of financial regulation, and each of it sometimes applies to a different set. So you've got, if we were talking much more on the commercial side of it, people would talk about the ring fence, the bank levy and the bank surcharge. That affects some, but not every part of the sector. A lot of the consumer regulation affects others. So it's just important that we're trying to maintain that open level playing field for competition. In some ways there shouldn't be that great market opportunity, because savers have had a very rough time of it. There are poor savers. There are people that have done what Conservative and other governments have asked of them, seen incredibly low returns, seen their savings eaten away by inflation. and arguably haven't been as well served by the financial system. So if people come in as competitors and see the opportunity, that's good. But then if there's some arbitrage in different people's regulatory costs, that sort of flows back to those who are holding the regulatory ring, both politicians in terms of setting the statutory regulation, and also those who implement the regulation, the regulators themselves. Are they making sure that the denominators of those are right? So I don't know if that's resonant. I mean, do you feel that you're picking up some costs and then you're seeing some others not bear those, or?
Well, I mean, yeah, so open banking would be a good example of that, where clearly that's the large providers have an obligation to take part in that the smaller entrants don't. And obviously you do have kind of the impact, as you alluded to, of the ring fence as well. You know, I think that from my perspective, I do go back to that point around kind of just trying to make sure that whenever we're looking at legislation, we spoke about this briefly, that kind of the needs of the mutual sector and building societies in particular is taken account of within that. And it is, you know, the big thing is because of our source of funding. Our source of funding is, you know, what we would call in banking sector retail consumers, what I would call members. That's where we fund all of our mortgages from. So making sure that that isn't compromised is kind of really important to us. But again, if it's a level playing field, competition's a good thing.
So how do we deal with that complexity? One answer is to be listening and engaging with the sector. So that's my role coming in, is to make sure I understand what the different disparate parts of the sector seek, and then to try and make, in my view, balanced decisions that deliver the societal outcomes, some of which are competition, but some of which are consumer protection.
Yeah, fantastic. Thank you, Andrew. Do we have any final questions from the audience? Okay, we have one double or second question.
Jumping in.
Sorry.
Just during the leadership campaign, we heard from both of the two candidates they were really interested in reducing the regulatory burden on banks and other financial service institutions to get more investment in the economy. But I suppose last week we've seen, for example, pension funds actually still quite a lot of vulnerability in our financial sector, maybe in ways we don't fully understand. So, given that, do you think it's still right to be looking at sort of lowering some of those regulatory requirements on financial service institutions and banks that were put in place after the financial crisis?
And I might just add to that, there's an interesting question about different types of provider and the risk that they carry, I presume, as well, given the types of capital that might be funded and the way in which they're leveraged. So, Andrew.
Yes, I mean, it is something that continually comes up again and again, and obviously there'll be individual points of detail, and that's why you can't just paint with a broad brush on this. You've got to look at the very different regimes that exist. A lot of them simply date back to a particular event in 2008. The world's moved on in many respects. Most of the UK regulatory rulebook for financial services, much wider than the banks, which has always been there, dates back to the year 2000. Now, the year 2000 was 7 years before the first iPhone. It was before the ubiquitous internet. It was before the blockchain, and it was before, you know, some really big developments, machine learning, algorithmic portfolio composition, and price transparency. I mean, you know, one of the big trends in consumers is greater price transparency. So there's a really good case for lots of reasons, again, looking at that rulebook, looking at where there are sometimes conflicting regulations. So it's a fallacy that regulation always makes you safer. You know, sometimes it can drive conflicting or even perverse incentives to do particular things. So, you know, one of the things less true of the retail banking space, but the investment space, is it's quite configured to short term. So it's quite hard, and you know, very astonishingly during the leadership election, people started talking about Solvency II, which is a degree of familiarity within the insurance regime that I wouldn't normally have expected to come up during a leadership campaign. But what that does is it makes it really hard for people with long-term liabilities to hold long-term assets against them. Now, there's actually risk in that system, because because if you say you're trying to match 20 and 30-year liabilities for everybody's long-term pensions and savings, but you're actually prohibited from holding assets that stretch out that long, and you're having to hold too many short-term assets because they're the ones that have got daily pricing available for, you're actually baking a different sort of risk into the system. So, look, you've got to be measured about these things. I don't think you should overweight one particular incident. People will have to look at each individual part of what is clearly a very complex financial tapestry, and then proceed accordingly.
Fantastic. Andrew, thank you so much. And as Tom particularly wanted to jump in on that question, I'm going to close the discussion there, but it's just in the interest of time, because I know that not only have our speakers got to get off to other events in their busy diaries, but we also are holding another event in this room in 10 minutes' time. So thank you so much to everyone. This has been a really rich discussion, and it's been very clear from this discussion that retail banking does have a very significant role to play in supporting consumers, families, households during what inevitably is going to be a difficult time. We've talked about different ways in which retail banking can do that. Some of that is about innovating the service to consumers, so whether that's innovating digitally through new products and services delivered online or indeed over the phone, through to in-person banking hubs, branch networks to provide services to people where they are. We've talked about the importance of the diversity of the market and the importance of having vibrant competition with different types of model of delivery. So credit unions, building societies, traditional retail banks, CDFIs have all come up and all have a role to play in supporting different parts of the market. And so it's very kind of useful from our point of view to see that whole panoply of different providers and to be thinking about it in the round rather than just thinking about specific types of delivery model. And then the last thing I would say is just, it's been really fantastic having Jane on the panel to talk through some of the very complex needs and deep-rooted problems that lots of people are facing, and the changing nature of some of that demand on debt services, but also kind of the broader retail banking sector. And I think as that demand shifts, we are going to need to take, as Andrew said, a data-led approach to some of those problems. We should not be bound by some of the problems of the past, particularly going back to 2008. We should be thinking quite seriously about the problems that people are facing right here, right now, and delivering service or developing services and products that fill those needs, that meet those needs. So thank you all for a fantastic discussion. Thank you in particular to our speakers for giving up their time, and to Nationwide for helping us to put on this fantastic event. I hope you've enjoyed it, and can you just give our speakers a round of applause?